Don't navigate the markets blindly. Technical analysis is the compass and roadmap for traders, providing valuable insights into market trends, momentum, and potential trading opportunities. By studying price charts and utilizing technical indicators, traders can make more informed decisions and increase their chances of success. Just as a map helps you understand your current location and plan your route, technical analysis helps traders understand current market conditions. By analyzing historical price data, traders can identify patterns and trends that may repeat in the future. This information is crucial for developing trading strategies and making well-timed entries and exits. This essay will serve as a beginner's guide to understanding and utilizing the power of technical analysis. We'll delve into the fundamental concepts, explore essential technical indicators, and illustrate their application through real-world trading examples. Whether you're a novice trader or simply looking to enhance your trading toolkit, the insights provided here will equip you with the knowledge to navigate the markets with greater confidence and clarity. At its core, technical analysis is the study of historical price and volume data to identify patterns and trends that can help predict future price movements. Traders who employ technical analysis believe that price discounts everything, meaning that all relevant information is reflected in an asset's price chart. By analyzing these charts, traders can gain insights into market sentiment, supply and demand dynamics, and potential trading opportunities. One of the fundamental premises of technical analysis is that price movements tend to follow trends. An uptrend is characterized by a series of higher highs and higher lows, while a downtrend exhibits lower highs and lower lows. By identifying these trends early on, traders can capitalize on the momentum and potentially ride the wave of price movement. Another key concept in technical analysis is support and resistance levels. Support is a price level where buying pressure is strong enough to prevent the price from falling further. Resistance, on the other hand, is a price level where selling pressure is strong enough to prevent the price from rising further. These levels are often identified by horizontal lines drawn on a price chart, connecting previous highs and lows. Understanding these basic concepts of technical analysis is crucial for interpreting price charts and utilizing technical indicators effectively. By recognizing trends, support and resistance levels, and other chart patterns, traders can make more informed trading decisions and improve their odds of success in the market. Technical traders have a wide array of tools at their disposal to analyze price charts and identify trading opportunities. These tools, known as technical indicators, can be broadly categorized into two groups: trend-following indicators and oscillators. Trend-following indicators, as the name suggests, are designed to identify and confirm existing trends, while oscillators help identify overbought or oversold conditions. One of the most widely used trend-following indicators is the moving average. A moving average is simply the average price of an asset over a specified period, with the calculation constantly updated as new price data becomes available. Traders often use multiple moving averages with different time frames, such as a 50-day moving average and a 200-day moving average, to identify crossovers that may signal a change in trend. Another popular indicator is the Relative Strength Index, or RSI, an oscillator that measures the magnitude of recent price changes to evaluate overbought or oversold conditions. The RSI oscillates between 0 and 100, with readings above 70 typically considered overbought and readings below 30 considered oversold. Traders often use the RSI in conjunction with other indicators to confirm signals and time their entries and exits. The Moving Average Convergence Divergence, or MACD, is another versatile indicator that combines elements of both trend-following and momentum indicators. The MACD is calculated by subtracting the 26-day exponential moving average, or EMA, from the 12-day EMA. A signal line, typically a 9-day EMA of the MACD, is often plotted alongside the MACD line. Traders look for crossovers of the MACD line and the signal line, as well as divergences between the MACD and price, to identify potential trading opportunities. Section 4. Real-world applications of technical analysis. To illustrate the practical application of technical analysis, let's consider a few real-world trading examples. Imagine a trader analyzing the chart of a technology stock that has been in a steady uptrend for several months. The trader observes that the price has recently pulled back to the 50-day moving average, which has acted as support in the past. Additionally, the RSI is showing a reading of 35, indicating that the stock may be oversold. Based on this confluence of signals, the trader decides to enter a long position, setting a stop-loss order below the recent low and a take-profit order near the previous high. As it turns out, the 50-day moving average holds as support, and the price rebounds sharply, hitting the trader's take-profit target within a few days. In another scenario, a trader is monitoring the chart of a currency pair that has been in a downtrend. The trader notices that the price has bounced off a resistance level several times and that the MACD is showing a bearish crossover, with the MACD line crossing below the signal line. Furthermore, the RSI is above 70, indicating that the currency pair may be overbought. Based on these bearish signals, the trader decides to enter a short position, setting a stop-loss order above the recent high and a take-profit order near the previous low. As anticipated, the resistance level holds and the price resumes its downtrend, hitting the trader's take-profit target within a few days.